This is the live session on Monday, February 5th, covering the Japan FinTech Observer the week ending February 4th. And as always, we've got 3 topics selected for you. Today, we want to talk about LLC-type DAOs, which are coming to Japan, and we'll talk about the background of that. We are squat in the middle of earnings season, so we had to pick one of the banks that reported last week, and it wasn't pretty. That was Aozora Bank, so we'll dive into that a bit. And then also we've seen transactions in Japan over the last 18 months, but then also last week again, private equity firms taking on life insurance books of the active life insurance books. So quite a bit to talk about. Good news on the DAO front, decentralized autonomous organizations. Going back to April last year, when the Liberal Democratic Party, the LDP, published its Web3 white paper. So if you haven't read it, there's an English version available. And so if you Google Web3 white paper, it's definitely worth a read. Japan had a long history in crypto that goes back to Mt. Gox, which is supposed to start paying out claims this year, or has maybe already done some of them, and was also first in establishing regulation around crypto exchanges. Then when CoinCheck was hacked just a year after that, recovered from that again. So there's been quite a resilience in the ecosystem. And so a Web3 future pioneered by Japan should be a rule-based order and should be a safe environment. So we've got cryptocurrency regulation, we've got stablecoin regulation, we've got security token regulation. So there is quite a bit of clarity, but this white paper essentially then in the first section here lists all the things that can be addressed, and the DAO issue falls into that. The second section of the LDP Web3 white paper were things that maybe take a little more conversation and discussion. If you look at this from a fiscal year perspective, the first section, maybe this will go into law fiscal year where we're currently in the tail end of 23 and early 24, and then the second section is like late 24, maybe even 25. This was actually the second white paper that the LDP put out. A year prior to that, they issued specifically a white paper on NFTs. So again, I think if you read the Web3 white paper, which covers the progress of the NFT one, you're covered. So what happened now? The FSA put out a notice for public comment. If you're inclined to read legal text in Japanese, you can find it on the FSA website. But ultimately, under current regulation, if you were to tokenize the rights of a limited liability company, an LLC, these would be type 1 securities. But with the changes that are being proposed, it would be type 2 securities. What that means is stated in the Financial Instruments and Exchange Act. So the paragraph 1 securities is mostly instruments that are traded on exchanges, and the paragraph 2 instruments are more liquid, like these things, like a limited liability company, a partnership, etc. You also need different licenses to deal with this. The idea is that the same business objective, having a limited liability company, should not depend on the technology implementation. So if I have an LLC that's done in a traditional way, it's a paragraph 2, but then I do it as a tokenized version, so paragraph 1. That doesn't really make sense. The changes that are being proposed address that. The comment period for that is March 4th. So if you have strong opinions around this, you're welcome to submit your comments to the regulator there. And then it will go to the Cabinet Office, will do some rulemaking, and then it needs to be implemented in the Financial Instruments and Exchange Act accordingly. So it might still take some while. Maybe the rulemaking will happen still within the 24 calendar year. That's great news for everybody who's been talking about DAOs a lot. And I've had on my podcast also a few conversations around that. My thesis was always to say that you need to bring the corporate structures that are available today and bring them together with the DAO structure, because either you create a new one or you use an existing one, and that's what happened here with the LLC. That makes total sense. Japan is on a very safe ground here going forward. And so great news. Other things that were in the first bucket of addressing it immediately, like taxation issues, both from a holding perspective and issuance perspective, they are doing what they said they would be doing. The big question is, how long are we going to have this government around and Kishida as a prime minister, which obviously then could mean that afterwards things change, but we'll see. Now, banking, we had so many. Among the big mega banks, we had Mizuho and Sumitomo Mitsui Financial Group reporting last week. We had MUFG just coming out with their earnings after the close today. We had some of the second-tier banks like Resona, and also some of the new digital banks like SBI, Sumishin Net Bank, which went public last year and is now on their second full quarter. I think they went public in April or so of 23. Then they had a partial quarter to report on, and then this was the second full quarter. SBI, Sumishin Net Bank is a mortgage specialist, so their goal is to take 10% of the market, and they seem to be on a good track there, but there wasn't really a surprise coming out. And most of the other earnings, there were some interesting data points, some buybacks and some new capital plans, etc. But the real surprise here came from Aozora Bank, which somebody described as, well, if you have a loan need and you can't get a loan from the mega banks, then you go to Aozora. That's really very flattering, but it clearly means then that you get credit risk that is higher and maybe not fully priced. But they did a full swing on the forecast. So in terms of ordinary profit, the original forecast was 31 billion yen. That is now forecast to be negative 49, so a swing of 80 billion yen. That's $500 million just about. Current rate, whatever, 148. So that obviously didn't go down that well. My good old friends at Goldman Sachs have this bank on the sell list, and it's a bit of and I couldn't, despite having done my CFA a long time ago, I couldn't fully dissect it, but I want to talk you through this. There were two components to this losses, and one were reservations on US office loans. These are non-recourse loans, which means that they only have collateral that's described in the loan agreement. If you have a recourse loan, then you could take the broader property of the borrower into account, but a non-recourse loan is if they can't pay anymore, then you simply take the property and try to sell it. Here, they actually relooked at their portfolio based on what happened in the fourth quarter, where interest rates peaked in the US close to 5% on the 10-year. They have now 21 non-performing loans and about 40% of their whole portfolio underwater, with an average loan-to-value ratio of 177%. I want you to keep that number in mind for a moment. If you have 19 million in outstanding loans and an LTV of 177, that means you've got around 10 million US dollars there that you could basically realize. This lower footnote indicates if you project it out over the next 2 years even, which might include some recovery. Now, they've increased the reserve ratio. Here's the end of the September quarter. On the right-hand side is the end of the December quarter. On the bottom of the right bar, you see, again, the 719 million US dollars. And they have a reserve ratio of 44.5%, which, if you multiply it out, is somewhere 310, 320 million US dollars. So if I just look at the non-performing loans, then I would say, well, you've got 400, 410 non-performing, and you reserve less, about 100 million US dollars less for that. So there's still potential for bad news to come out. And the sliver slightly above that, the properties, only two for 92 million, have a loan-to-value ratio between 90 and 100%. They're certainly marginal, depending on how the office market in the US develops. Now, the second item was the securities portfolio, which is also a bit bad. Consider this again, it's a second tier bank in Japan, and that's been apparently investing relatively large amounts of money in mortgage-backed securities and fixed income ETFs. It feels a bit like 2000 or maybe 2006 to 2008. I don't want to bring up the last global financial crisis yet. I don't think it's that bleak, but also realize that while they enhance the provisions on the real estate side quite substantially, they've only realized 9 billion yen of losses on the securities portfolio. So they had 19.6 billion of unrealized losses at the end of September. They realized some of that by selling off lower grade bond ETFs. I think in the fourth quarter, they realized another just about 27 in losses. So this quarter was more for real estate, and next quarter will be a bit more on the securities repositioning. But at the end of the fiscal year, the unrealized losses will still be 50 billion yen. The picture underneath is what the interest rates did in the US for the 10-year Treasury in the fourth calendar quarter 23, which is the third for Japanese companies starting their fiscal year in April. Higher interest rates mean lower bond prices. We clearly ended at a lower interest rate. We touched 5% in November. We ended up just over 4%. The fact that they're now starting to take losses on this portfolio shows you that they've most likely held on to these for quite a while. So these are not things that they purchased over the last quarter. They have a duration of 5 years and 6 years on the mortgage-backed securities and the bond ETFs, which is quite long, right? And if you look at the weekly report, where we found information in the earnings reports of the other banks, we listed them, and most of them have a much shorter duration in their portfolio, which either means they have shorter bonds or longer bonds, and they've hedged it appropriately. And so there's a bit of gambling going on here, bad risk management, maybe on both sides, right? Both in terms of the securities portfolio not being used to relatively rapid interest increases like we've seen over the last year and a half, and also playing in US real estate. Clearly, the hunt for the additional yields being baked in there. And that's where you start to wonder a bit, do we have maybe some of the regional banks who really have been beaten up through the negative interest rate policy and are hungry for higher yields? Maybe some of them dabbled in US bond, maybe also not so good risk management. So maybe there's a few skeletons in the closet still. Who knows? If you look at it from a historical perspective, right, 4% yield on the 10-year isn't really that high yet. It's high because we come out of a negative and zero interest rate environment. We see this in the economic numbers in the US as well. If you have a strong economy, that's an interest rate level that doesn't start hurting that much yet. It hurts the consumers more than it actually hurts the corporates. And so the middle income layer gets beaten up again. But are we talking now about something like the Silicon Valley Bank run last year? Probably not quite yet. So the capital ratios that Aozora projects is at the end of the fiscal year below where it should be. It should be a domestic capital adequacy ratio of 9% and the common equity tier 1, which is a BIS, Bank for International Settlement measure of 7%. They have not articulated any measures to specifically address this. They own a good chunk of GMO, Aozora Bank. We're simply going to get out of that hole, and by the end of the 24 fiscal year in March 25, we'll recapture the highs. Whether they get forced either through market events or through the FSA to maybe be a bit more aggressive, maybe both in terms of the disposal of the securities portfolio and then maybe also aggressive in terms of raising new capital, remains to be seen. The law of unintended consequences, this actually happened just based on US interest rate environment, or let's say the ex-Japan interest rate environment. Maybe a bank where you wouldn't necessarily expect US market exposure, certainly not in terms of the real estate. And so they serve the blooper here. I'm the pessimistic type, as you might have noticed. I'll pick some cases that are maybe not that pretty. If you want a book recommendation from me, I've actually read about 80 books last year, or listened to probably half of them. Plunder came out in May or so and is a take on private equity's approach to what Brandon calls here pillaging America. You can form your own opinion whether you agree with the statement, but it certainly sells. One of the chapters in this book is specifically on life insurance and the takeover of life insurance companies, making them captive to private equity firms. Brandon in this book goes through many different industries. Life insurance is just one. That's where I picked up and got sensitive to this topic the first time. Then at the end of last year in December, the IMF actually issued this global financial stability note, private equity and life insurers, which also covered that topic. You could say certainly Brent isn't the only person worrying about this. If the smart people at the IMF write a whole note about it, there's maybe something to it. Last week, Zurich Insurance Group was selling $20 billion of the life insurance book to Viridium, the German private equity backed company. Viridium previously had invested in the book of an Italian life insurer, and that wasn't capitalized properly and went into receivership. Here, the ownership structure refers to the private equity-owned business. It's between Zurich and their regulator. Some people got uncomfortable given the focus on the industry and the prior history of Viridium here. And so this deal is off. That was one of the biggest that we have seen. Why did I make it a topic also in the weekly newsletter? There's a similar company, Resolution Life, which is headquartered in Bermuda. And so very often you find these vehicles in jurisdictions that might be a bit more flexible. But they also did 1.5 years ago, in the middle of 22, they did their first deal in Japan with Dai-ichi Life. And last week, they announced their first reinsurance partnership in Japan, or flow reinsurance. The interesting thing is that somewhere in between these two transactions, namely second half last year, Resolution Life raised quite amount of capital. They got $500 million from Blackstone, and they actually got $1 billion from Nippon Life. So you see the large insurer here, Nippon Life, playing this game possibly on both sides. They've taken the investor side as an alternative investment rather than selling some of their loan book. But so we have Japanese players here on both sides of the transaction. Actually, the good people at Standard & Poor's Global also published in the middle of January only a list of transactions in Asia. This is not meant to be a fully comprehensive list, but it picks up select transactions. It doesn't have the Resolution Life deals in there, for example. The green dots are transactions in Japan, which is the majority, and then there are 2 in Hong Kong and 1 in Singapore. FW Life, also Hong Kong headquartered, but for the Japanese entity, which I believe was previously an AIG business that they acquired. Then the third from the bottom, Manulife Japan, listed here as a transaction of $4 billion US. Allegedly, that transaction is just the first part of a larger package that extends to 10 billion, but there was no further information available whether all the 10 billion are in Japan or some of that is Manulife globally. If it was 10 billion in Japan, clearly it would reach a volume that's 50% of the Zurich transaction that just got blocked. 10 billion would probably get to a level where at some point the FSA wakes up to and starts looking at this a bit more carefully. The TSE pressure on being conscious of the cost of capital and profit. So this selling a book of business certainly gives cash flow, gives flexibility. There might just be many more of these transactions in the pipeline, and at some point it will have an impact on the financial stability of the insurers. I actually should check whether they have as part of their work plan for the current fiscal year. And yeah, that was the last slide for today. So we have good news on the DAOs that's moving forward, and many things on the list of the LDP regarding the Web3 white paper is moving forward, which has many people very excited, and hopefully also brings some of the Japanese founders that have established their companies abroad because of the regulatory or tax perspective back to Japan. Some of these rules are called the Watanabe Sota rule for the founder of Astar and the Astar Foundation, Startail Labs, who did just that. And there's nothing that the Japanese government would like better than him actually bringing the entity back to Japan. Second item was bank earnings. That continues this week. The 9th, I think Friday, is the peak for this year's reporting. And once we're through this, around 80% or so of the companies will have reported. We focused a bit on the banks this week because of the Aozora story. So hopefully next week we can look more into the insurance side. Some of the FinTech companies that are listed, like Money Forward, they run on a fiscal year that ends in November. They reported earnings in early January. We covered some of that in our weekly report at that time as well. That's it for today. We have more this week. A commitment from Bruno Diniz, who is one of the best, if not the best, fintech analyst for Brazil and Latin America. The last time we spoke was almost exactly 2 years ago, and 2 years is a long time for the fast pace of a country like Brazil. I think lots of updates in terms of PIX, which is a real-time payment system, the Brazilian CBDC, Nubank as the largest fintech in Latin America, being super successful, and many other topics around it. I think will be an exciting conversation on Wednesday, starting at 9 p.m. Japan time. That would be 9 a.m. Sao Paulo for Bruno. And so if you're inclined to join us on Wednesday, please do. The next edition here for the weekly recap we'll try to do again on Monday, February 12th. It's a public holiday here in Japan. And as long as we're recovered from the Super Bowl in the morning, then we should be in good shape to dive into a few topics again like we do here. Thanks for staying with us. Please do the weekly newsletter on LinkedIn, forward it to a few friends. We're at 8,800 subscribers now, and clearly it's been a good ride. We'd like to get it to 10,000 this year, which I think we'll do with your support. So thanks for being here. And if you have any questions, please do message me. And you've got my email address here on the screen as well. All right. Have a good night. Take care and have a great week ahead.